السلام عليكم. لا تنسوا الإعجاب والاشتراك في القناة تشجيعا لنا لمزيد من العطاء والتألق.
I know many of you have seen a lot of videos on chart patterns on YouTube and how to trade them. But most of these videos don't tell you why you should trade them and in fact why these chart patterns actually work in the market. So this is going to be one of the most comprehensive courses on chart patterns out there. Many professional traders even sell paid courses on chart patterns that are worth thousands of rupees with very little content. But guess what? This course is completely free of cost and is exclusively for educational purposes only. So share it with all your fellow traders and friends. And if you are new to the channel, consider subscribing to the channel and also enable the bell icon so that you won't miss out on any upcoming videos.
The head and shoulders pattern is one of the most popular reversal chart patterns out there. And because it is popular, the chances of making a mistake is also high. Now let us understand what this pattern really implies. Actually, the pattern consists of 4 different parts: the left shoulder, the head, the right shoulder, and the neckline. Overall, the pattern looks simple, right? But what does it actually mean? And why does it matter? Let's analyze this in greater detail. We will start from the left shoulder. The initial trend in the market is an uptrend where the prices rallies higher and then the market does a pullback or a correction, and the left shoulder is formed as the market does a pullback. And at this point, there is no way to tell if the market will reverse because a pullback occurs regularly in a trending market and it may just be another swing low from which the prices can move higher. The market then trades above the previous swing high, forming a higher high. However, the sellers take control or resist the upward rally and push the price lower towards the previously formed swing low. Now, the swing high formed as a result of this price action is the head of the pattern. Also, the line connecting both the swing lows forms a support level called as the neckline. Now, what we can observe here is that the uptrend structure of higher highs and higher lows is violated. But still, we cannot guarantee that a reversal will happen because the price might even trade sideways. Now, once again from the neckline, the buyers make a final attempt to push the prices higher, but they fail to even break above the previous high of the head of the pattern. And yet again, the sellers take control and push the price towards the neckline. This forms a lower high in compared to the previous high, which indicates a shift in the sentiment towards bearishness. Now, the only level that stands in favor of the bulls is the neckline, which is also a support level. Or in other words, the neckline is the last line of defense for the buyers. And if the price breaks below it, the market could head lower and begin the start of a new downtrend. So basically, the head and shoulder pattern signals a possible trend reversal as the buyers fail to push the prices higher. Are all head and shoulder patterns worth trading? Actually, there are a few things that you must seriously look at before you trade the head and shoulder chart pattern. These things are associated with how reliable is the head and shoulder pattern formed. Now, what you need to understand is that not all head and shoulder patterns are created equal, because how the right shoulder forms is a key criterion to whether you want to trade the breakout or not. For example, if you have a head and shoulder pattern that has a very long right shoulder, then you want to avoid buying the breakout. And why is it so? Because the price has moved a very long distance from the highs of the right shoulder to the neckline or the support area, which will attract more sellers on the way. So the market is likely to face a buying pressure due to the profit booking by the sellers and also from the traders who want to buy from the support level. Now, this creates a strong buying pressure which will lead to an increase in the price and the pattern will fail. So make sure that the right shoulder is shallow and ideally it should stay below 50% of the head. Other than this, there are 2 more things you must pay attention to while selecting the best head and shoulder patterns. First one is the market structure and the second one is the duration of the pattern. Let me explain each one of them. It is true that head and shoulders is a reversal chart pattern, but if the market is in a very strong uptrend, it is very unlikely that a simple chart pattern can reverse the entire up move. Instead, the market is likely to continue higher. Maybe the pattern can generate a short-term retracement, but not entirely a reversal. So make sure that you don't bet against a very strong trending market just because you have seen a head and shoulder pattern. Now the second factor is the duration of the pattern. A typical head and shoulder pattern can take 200 days, 20 days or even 20 minutes to form depending on the chart time frames that you follow. But with some common sense, it is very obvious that the pattern that takes 200 days to form is more significant than a head and shoulders that takes 20 days to form, which is more relevant than a pattern formed in 20 minutes. And why, you may ask? Because if the market breaks the 200-day pattern neckline, there will be more traders or buyers who bought at the support, and most of them will keep their sell stop loss orders just below the neckline. Now these buyers will get trapped and they will rush for exit, or their sell stop loss orders will be triggered on breakdown, which will further increase the selling pressure. Now when you take the case of the pattern formed in 20 minutes, this may not always hold true because only very few people are aware of it, and the pattern may not give you the desired result. So a head and shoulder pattern on a higher time frame and one that took more time to form has a higher chance of success. Now this does not mean you go short immediately when the price breaks the neckline. There are a few ways to trade the head and shoulder chart pattern in the best possible manner. Now I will start off with the trade entry techniques, and there are 4 possible entry methods for this pattern. The first and most aggressive entry is when the price breaks down the neckline. Now the idea is to wait for the breakdown candle to close below the neckline and then take a short entry below the close or the low price of the breakout candle. Now the advantage of this technique is that you will be able to enter into a trade very early and perhaps you will get the best possible entry price, but the drawback is that the price could reverse and give a false breakout and might even hit your stop loss. So the second entry technique is associated with a breakout following a build-up of prices. Now build-up means a tight consolidation of prices near an area of value, prominently near a support or resistance level. You can learn more about this concept in the secrets of support and resistance in my price action course. In this case, we will wait for the market to form a tight consolidation near the neckline or support level. And if the market breaks down, you can reference your trade entry just below the close or the low of the breakdown candle. Now the advantage of this method is obviously the tight placement of stop loss and an improved reward to risk ratio, which we will discuss in the next section, and it also provides a good entry price. But the drawback is that the breakdown candle can be huge and you will be selling at a much lower price. Now you might be wondering, what if I miss the breakout, or what if the market doesn't form a build-up and still continues to head lower? Won't I miss out on the trade? Now this is a relevant question because build-ups don't actually happen every now and then. So another common method is waiting for a primary pullback in prices. This technique lets you catch the price move even after a breakdown. Now here is how it works. So if the market breaks down without forming a build-up, then we will wait for a primary pullback to occur, which is a temporary up move of prices with weak candles, which generally resembles a flag or pennant pattern, which you may obviously know how to trade. And eventually if the market does a pullback, then you can look to go short on the break of the previous swing lows or enter right away when the price starts moving lower. And as I have mentioned, the best pullbacks are those with shallow retracement and small bodied candles. But what if we get a steep pullback and with large bodied candles? What will we do then? Now, if the pullback is deep, then we will wait for the price to retest the neckline or the previous support turn resistance level as per the principle of polarity. We have to observe if the price retests the neckline and then wait for a price rejection from the neckline in form of bearish reversal candlesticks like shooting star, bearish engulfing pattern, evening star, etc. You can learn more about reversal trading using candlesticks in my price action course. And if you find there is a price rejection, then you can go short on the very next candle. Now the retest technique lets you time your entry and even short the market at better prices. But the downside is that the market will not always do a retest and you might miss out on the trade altogether. Another important point to keep in mind is that the volume should decrease during the formation of the left shoulder and the head, indicating a loss in the buying interest, and it should rise during the formation of the right shoulder and also during the breakout, confirming an interest in selling. So make sure you use the right entry techniques at the right times. Now let us talk about the placement of stop losses with respect to our entry criterions. as I have discussed multiple times, the stop loss should be at a level that if breached will invalidate your trading setup. Now since we are dealing with a head and shoulder pattern, your stop loss should be at a level that invalidates the pattern altogether. To be fair, if the price moves above the right shoulder, the pattern will get invalidated. So if your entry was aggressive as and when the price breakdown from the neckline, then you should set your stop loss at or above the right shoulder of the pattern. Now what if you took a short entry after a build up near the neckline? Then you get the freedom to place a much tighter stop loss, preferably just above the build up consolidation, which will boost your reward to risk ratio by some margin. Now let's say you missed both these entries and you shorted the market after the prices formed a primary pullback. Then set your stop losses above the highest price in the group of the pullback candles, or just place it above the neckline if the pullback is formed very close to the neckline. And the last method is if you have entered after a retest. In this scenario, the stop loss can be placed just above the highest wick of the group of retest candles, or you can be more conservative and place the stop loss above the right shoulder of the pattern. And finally, we will take a look at how to exit from our trade for maximum profit. Well, there are three popular techniques that you can use: the price projection method, the trailing stop loss method, and a combination of these methods. Now let me explain each one of them. The price projection is a classical charting technique that determines where the move might end. Now it focuses on price exhaustion. The idea is quite simple. The prices will move a distance equal to the highest width of the pattern. Now in this case, the highest width of the pattern is from the neckline to the head. So all you have to do is to measure the width from the head to the neckline and then project this distance from the neckline towards the downside. The second method is more like trailing your stop loss to ride big trends. Now, if you have followed me on my last video, you know how to trail your stop loss to ride massive trends in the market. One way you can do this is to trail your stop loss with moving averages. The selection of moving averages will depend on the time frame that you're trading on. For short-term trends, a 20 moving average will do the job. But for a medium-term trend, a 50 moving average will be a good choice. And for a long-term trend, a 100 or 200 moving average is the best possible option. The idea is to ride the trend until the price moves above the trailing stop loss, where you can exit your position. The last method uses a combination of both these techniques. The idea is to exit half your positions at the price projection level and then ride the rest using a trailing stop loss. By doing this, you will be able to lock into some good profits and not fall prey to the market reversals. Now, I would like to add a few more points as to when and where to trade this pattern on the charts. So when you think about it, head and shoulders is a reversal pattern, but it is also a bearish breakout pattern. With that idea in mind, you can either trade this when the uptrend is weakening and you find a head and shoulder pattern that confirms the trend change, or you can also trade this pattern when the market is in a downtrend and the pattern appears as a temporary pause in the downward price action. Now, by doing so, you are taking a trade in the direction of the trend and not against the forward prices. But make sure that you don't bet against a very strong uptrend just because you spotted this pattern, and it may not work in your favor then. Moving on, the inverse head and shoulders or inverted head and shoulders or reverse head and shoulders pattern is a bullish reversal chart pattern that signals that the buyers are in control. It is just like a mirror reflection of the head and shoulders pattern. So I won't be digging deep into the minute details of this pattern. Anyway, let's find out what inverse head and shoulder pattern really means. This pattern also has 4 parts. The left shoulder is the result of a pullback against the downtrend, either because of a profit booking or eager buyers stepping into the market. But the sellers are still in control as they push the prices lower. However, the buyers are also stepping in, which explains the stronger pullback to retest the previous swing high level, which forms the head of the pattern. From this, we can assume that the sellers are getting weak as they couldn't push the price lower. Instead, the buyers are getting stronger as they continue to push the prices higher, retesting the resistance area or the previous swing high, which forms the neckline of the pattern. Now, the sellers tried to push the price down one last time, but they were met with the intense buying pressure, thereby forming a higher swing low compared to the head of the pattern. Now, this forms the right shoulder of the pattern, and it tells us that the sentiment has changed from bearish to bullish. And if the price manages to break above the resistance, then the inverse head and shoulder pattern is confirmed and the market could continue higher. Now, you might be thinking of buying when the price breaks out of the inverse head and shoulders and gain some profits. But this is not easy because not all of them are reliable. What matters is the strength of the market structure and the duration of the inverse head and shoulder formation. So if the market trend is strongly bearish, the chances of reversal are quite dim even if the pattern forms, and it could just be a short pause before the continuation of the trend. Now the other point is that the longer the inverted head and shoulder pattern takes to form, the more significant it is. This also means that the shorter the duration of the inverse head and shoulder pattern, the more likely it will fail, especially when you're trading it against the trend. Also keep in mind that how the right shoulder forms is also a key criterion for whether you want to trade the breakout or not. So let's say you have an inverse head and shoulder pattern that has a very long right shoulder, then you might want to avoid buying the breakout because the price has already moved a long distance from the lows of the right shoulder to the resistance area, which attracts more buyers along the way. So the market is likely to face a selling pressure from the profit booking by the buyers and also from traders who want to sell at the resistance level. Now this will create a strong selling pressure which will lead to a price decline. So a rule that you can follow is that the right shoulder should be above 50% of the head of the pattern. Now let's talk about when you trade the inverse head and shoulder pattern. Even though this is a reversal pattern, the idea that inverse head and shoulder pattern is a bullish breakout pattern is more prominent. So it makes sense to trade this pattern when the market is in an uptrend. And when you trade the inverse head and shoulder pattern in an uptrend, you just increase your odds of winning because you are now trading with the trend and not against it. Another opportunity to trade this pattern is when you spot this pattern at the end of the downtrend and the inverse head and shoulder pattern acts as a confirmation that the existing downtrend is weakening and there is a possibility that the market might reverse and move higher. But make sure that you don't trade this pattern in a very strong downtrend because the possibility of trend change is very low in such instances. Now let's move on to learning how to trade this pattern when you're
السلام عليكم. لا تنسوا الإعجاب والاشتراك في القناة تشجيعا لنا لمزيد من العطاء والتألق.